What is the first discount rate that you can pay? That's the 10. That's 10. So you can start with the year. Cash flow. Discount factor. And 10% discount rate and then discounted cash flow. Online students, can you see the code?
Yes.
Thank you. Right. So we have a year 0 and then first year the 6th of 5th year. 6th of 5th year, 6th year, right? You are going to have the same cash flow. It might be an annuity now. It might be an annuity, right? 5,430. Is this the cash flow during 6 years period? Good. Right. Year 0, how much is the cash flow? 20,000. Is that 20,000? 20,000 minus 20,000. Right. Year 0, discount factor is 1. So therefore, obviously, you are going to have a minus 20,000. Right. We have an annuity now. We have an annuity. We have an annuity. If it is an annuity, what you can calculate, no need to go one by one. This is the same cash flow during the 6 years period. So therefore, you can obtain the annuity factor. So therefore, working number 1. Working number 1, annuity factor. Working number 1, annuity factor. Annuity factor. How you can calculate the annuity factor? 1 minus 1 divided by 1 plus r to the power n divided by the r. Calculate the annuity factor now. 1 is fixed amount. So this is 1 divided by 1 plus r now 0.1. We are finding the annuity factor for the 6 years period. So therefore, to the power 6 divided by 0.1. What will be the annuity factor? What's the annuity factor? 4.34. Right. Apply the additive factor here 4.34. Now multiply the additive factor in the cash flow. How much is it? Multiply the additive factor with the cash flow now. 23,500. Now you can obtain the NPV. What will be the NPV then? Positive 3,566.2. You obtain now positive NPV. To calculate the IRR, we need the negative NPV also. You have the NPV negative. Again, you need to increase or decrease the discount factor. Increase the discount factor. If you increase the discount factor, definitely your cash flow values might be decline. So then you can have the negative NPV accordingly. You go to the calculation of NPV again under the discount rate of we have taken here 20 and 10, 20. Right? Now recalculate the NPV. We have here cash flow discount factor now at 20% and then discounted cash flow. Discounted cash flow. Here 0, 1 to 6 here. 20,000 minus cash flow. But same cash flow during the 6 years period. It's obvious 20,000 for the first year minus. Now working number 2. Working number 2. What's the working number 2? Annuity factor again. Working number 2. Working number 2. That's the annuity factor A at the discount rate of 20%. How to calculate the annuity factor? 1 minus 1 divided by 1 plus R. The basic formula is given here. Right? Yes, okay, 20. If you want to take 20, that's also okay, no issues. But just we need the 2 discount factors. Here 1.5 to the power 6 and then divided by 0.15. Take the NPV, take the annuity factor and then calculate the NPV. 5,430. 5,430. Calculated. Budak bukan sama aja prinsip. Jadi ini 3.5. 3.5. So then you also 4.5. 4.35. So then what will be the value here? 23,620.5. 23,620.5. So then NPV becomes 3,620.5. Now take the negative NPV for the average discount rate of 15 and go to the bond valuation yield material calculate the IRR. In there I can give the IRR formula. In the side I can give the IRR formula. $3.7. 3.7. Discounted cash flow with annuity factor 19,000 something. 50,525. 25.4. NPV then 525.4. Now we have two discount, the two discount rate plus two NPV values. Then how you can calculate the how you can calculate the IRR then? IRR equals how you can calculate lowest discount rate. What's the lowest discount rate? Again, write down lowest discount rate plus NPV and lowest discount rate divided by NPV and lowest discount rate minus NPV and highest discount rate multiplied by the difference between highest discount rate and then the lowest discount rate. This is the formula. Right? Okay. What's the lowest discount rate here? Lowest discount rate 0.1. Highest discount rate 0.15 minus 0.5. NPV at lowest discount rate, how much is it? 3,620.5 divided by 3,620.5 minus 525.4 multiplied by the answer. What will be the discount? What will be the IRR? 0.158. Or else you can denote it as 15.8. 15.8. Right. Okay. If the question given to us, company back is how much? Company back is 50. Overall cost of capital of this organization is how much? That is 15%. If you remember the overall weighted average cost of capital, if you remember that part, last week we have calculated the weighted average cost of capital. What do you mean by the weighted average cost of capital? The overall rate that you are paying to the outsiders or as the fund providers. We call it as a weighted average cost of capital. If the company overall weighted average cost of capital is 15%. 15%, and then if you are taking your IRR of this project, specific project, it has a 15.8. Tell me, are we going to undertake this project or else not? Yes or no? You can obtain the funds and then you can pay for them the 15%. 15%. Right? But if you are investing that obtain funds into our project, it definitely to have the no profit level, you have to have the 15.8%. Right, that will be the return. So then what will be a decision? Invest or not to invest? Yes. What is your decision? Invest or not to invest? Not to invest or else invest? Okay. Sarah, tell me the weighted average cost of capital, that is 15%. Other one, that is 15.8. That means higher than the overall weighted average cost of capital. Do we need to accept? Yes, we need to accept. Why? So we can have the whether if we are obtaining funds, we can obtain the 15.8, and then to have the no profit level, you have to identify the until the 15.8. So therefore, since the IRR is higher than the weighted average cost of capital, you can accept the project. Okay. Write it down. Write it down. Since weighted average cost of capital is 15%. And the project IRR is 15.8%. It is higher than the company overall cost of capital. It's better to undertake this project. Company weighted average cost of capital. Company weighted average cost of capital. It's better to undertake in this project. Invest in this project. For undertaking this project. Okay. Now, right. Now we'll go to the profitability index. Right? Make the heading profitability index. Again, sir, high value consider discounted technique. Investment technique. Right. So what we have done in the PV calculation, again we are representing it another way. Right? So look at this formula. Profitability index compares which one? Initial cash outlay and then present value of the cash inflow. So therefore, if we have taken the present value of all future cash flows, it's very easy to calculate the profitability index. Same end as the same NPV, but the thing is we are expressing this, the formula, we are expressing this, the project evaluation based on the index wise. That is why we are dividing the PV of cash flows by the initial cash outlay. Right? Present value has already calculated in the NPV. Initial cash outlay identified. But we done in the present NPV calculation from the future cash flows, we done the initial cash flow and taken the positive or negative. Here what we are doing, PV divided by the initial cash flows and express it as an index Y. Clear? Right, okay. Write down the formula and quickly calculate the profitability index for the first question. Formula, write down formula. Write down the formula. Write down the formula. Profitability index equals PV of cash flows divided by initial cash outlay. It's okay. Calculate for the given question. It's like now write it down. Once after you write down the formula, with reference to the question number 1. With reference to the question number 1 and 2. With reference to the question number 1 and 2, the calculated PI index are as follows. The calculated in PI profitability index, that means PI is as follows. In the question number 1, we have calculated the PV of cash flows and taken the outlay. Calculate it quickly. Question number 2, IR are also the same. With reference to the question number 1 and 2, the calculated PIR as follows. I will do it here with figures. Right? Question number 1. Online students, we are referring to the question. We are not going to the question number 3. Do it as a homework. Now, since we already calculated the present value of all future cash flows in question number 1 and 2, we'll calculate the profitability index based on the question number 1 and 2, the calculated values. Okay, question number 1. If you calculate the PI for the question number 1, profitability index, PI equals present value of cash flows divided by the initial cash outlay. In the question number 1, what's the profit? What is the initial cash outlay? Answer the question number 1 and tell me initial cash outlay 2,500. 2,500. Present value of all future cash flows 2,725.51. Now calculate the profitability index, that is 1. This is calculated with the question number 1 to come. This is referred to the question number 1. What is the profitability index now? 1.09. 1.09. It's greater than 1. Why it is? It's greater than 1. If the NPV, okay, I claim that if the NPV is positive, definitely PI also higher than the 1. Are you agree with this statement? Yes. Why? NPV plus means definitely it generates the initial cash outlay. It generates the cash flow and the initial cash outlay. So which become the present value become higher than initial cash outlay. Obviously it leads to a 1 plus value, right? 1 point something or else 2 point like plus. Right. Question number 2. Question number 2. Now profitability index. Profitability index. Initial cash outlay, that is 20,000. Future cash inflows under the discount factor 10%. That is 23,600 20.5. What will be the profitability index? Again, 1.18. 1.18. Right? 1.1. What's the difficult thing is here? Calculation of present value of the cash flows. Present value of the cash flows. How you can take the present value as we did in the NPV calculation. Okay. Without taking a break, we'll continue until the 6th minute. We'll finish it quick, yeah? Okay. Now the payback period. Payback period. This is very much simple and then you can calculate the profitability in the payback period. Payback. What do you mean by payback period? How many years you are going to have to recover the initial investment that you made? Right? Payback period. How you can calculate the payback period? Initial cash investment divided by the annual cash inflow. Annual cash inflow, you can do this one only if the annual cash flow is similar to the during these several years. Otherwise, you can't apply this method. Right? The rationale behind this, how many years that we are going to have recover this initial investment. And we call it as the payback period. Okay, question number 4. It's simple question. Not in the percentage. You have to make the investment of 50,000. 50,000. Right? And then annually you are considering 12,500. You are receiving 12,500. So it asks payback. How many years you are going to settle? How many years you are going to have to settle your initial 50,000? This is the one of investment techniques which doesn't use the present value of the cash flows. There are no discounts. We just take the cash flow as it is. Right? How many years? How many years? 4 years. 4 years. How are you going to take it as a 4? 50,000 divided by 12,500. 12,000. But no. $50,000 divided by 12,500 is 4 years. Right. Now something different. Right? If you are receiving the uneven cash flows this year, 20,000, next year 25,000. Again, this third year 10,000. Right? But if there are different cash flows, how you can recover this investment? Right? Now you can divide the initial cash outlay by the annual cash flow because we have a different annual cash flows. Now you have to see how you can recover this initial investment 20,000. Yes. Yes. Now how you can identify? Yeah. How many years we have now? 4 years. 4 years. Year 0, first, second, third, fourth. And then we have the cash flows. First year cash flow. How much is the first year cash flow? 20,000. That's the foregone cash flow, right? First year cash flow? 8,000. Second year? 7,000. 7, 4,000. 3,000. 3,000. Right. Now the last one should be accumulated. Accumulated cash flow. Right. At the end of the first year, you are able to identify or else recover 8,000. Am I correct? Yes. At the end of the second year, you have the first year 8,000 plus second year 7,000 or 15,000. Right? Fourth year we have the 15,000. So third year we have the 15,000. Third year amount accordingly 19,000. Right? And then at the end of the fourth year, definitely you have the 19,000 plus 23,000 means 22,000. 22,000. But how much is our initial investment? That's 20,000. Right? That is 20,000. So then how you can identify the payback period? Payback period. How many full years we are going to have take this recover this investment? First, second, third. So therefore, at the end of the third year, definitely we will be able to complete the 19,000. But in between this third year and fourth year, you are going to have 3,000 and then recover 22,000. Right? During the third year, how much you are receiving? You are receiving 3,000. But how much do we need? How much do we need to recover this investment? How you can identify? So our value is 20,000. Already we have identified or let's recover 19,000. So therefore our requirement is 1,000. But we are receiving 3,000 for the year. You have to identify if you are in this year, if you are going to have 3,000 during the year, to recover only this 1,000 rupee out of this 3,000, how many months you have to spend? Exactly, that is 4 months. 4 months. So then you can identify your payback period. Payback period equals 4 years, 4 years, and 3 years and 4 months. 3 years and 4 months. Clear? We just need to know the time value of money. What is it? In the next calculation, we'll identify once we'll consider the time value of money. Any doubts here? Any doubts? Right. Okay. If it is so, we move to the discounted payback period. In the heading, discounted payback period. Discounted payback period. We have calculated the payback period without identifying the time value of money. Now you need to identify the time value of money. How you can identify the time value of money? By converting the future cash flows into the present context. Right? So therefore, if you are going with the discounted cash, the discounted payback period, what is the first task? You need to convert the future cash flows into the present context. So then, in between the cash flow and accumulated cash flow, we have two columns, new two columns. What are those two columns? First one is the discount factor, and then you have to identify the discounted cash flow. Discounted cash flow. Once after you took the discounted cash flow, you need to calculate the accumulated cash, discounted cash flow. So this is the way of doing it. Right. Discounted cash flow. Question number 6. Read the question number 6. And try to do it. Only in columns, calculate payback period, then discounted cash flow, and then the accumulated, the discounting factor as well as discounted cash flow. Discount factor. That is 10% of time. Now I implement the discount factor. Then I will estimate. Last one is the okay. Okay. Now we have here, and then we have cash flow. We have discount factor and the discount rate of 10%. Then we have the discounted cash flow. Once you have the discounted cash flow, you can take the accumulated discounted cash flow. How many years? 5 years. 0 cash flows. Initial year 20,000. Right. So then cash inflows 88,000. 7,000. 4,000. 8,000. 4,000. Then discount taxes. First year 1. Then 20,000. Is 20,000. But we'll start from the first year onwards. Here 0.909, 0.826, 0.751, 0.6833, 0.621. Now multiply this discount factor with the cash flow. Tell me the discounted cash flows. 7,000. 5,780. 8,004. 2,049. 2,484. Right. Now we accumulated. Accumulated discounted cash flow. For the first year, we will be able to recover the 7,272. Right? Second year, what will be the accumulated discounted cash flows? 13,054. 13,054. Third year, 16,058. 16,058. 58. The fourth year, 18,107. The last year, 20,591. How much do we need? We need 20,000. We need 20,000. Right? So therefore, we can identify the payback period. Payback period equals definitely how many years? 4 years. 4 years plus. Right? During this year, how much are we going to have? That is 2,487. Yes, 2,484. But how much do we need to recover our investment? That's the 20,000 minus 20,000 minus 18,807. So therefore, tell me how much do we need? 1,890. Divided by during that year, how much are we going to have? 2,484. Right? If it is so, you have to convert it for the 12 months. 12 months means you have to identify how many months that we are going to have to convert to have this amount if we are receiving 2,484 during the years. During the year. How many months? 9 months. 9 months. So therefore, payback period equals 4 years and 9 months. 4 years and 9 months. You have this calculation of Right. Okay. Any question on the discounted cash flows? Discounted cash flows? No. Okay. No, we have another matrix, the last matrix. Accounting rate of return, the last one. ARR. Accounting rate of return. Accounting rate of return also coming under non-discounted cash flow criterion technique, which compares the average income, right? Average income or average profit divided by the average investment, right? So if we have given the number of years for this investment, we have to calculate the per year income, per year profit, and that per year profit should be divided by the average investment. How you can calculate the average investment? Opening investment plus the ending investment. What are the ending investment cash flows that you are receiving? Working capital. And sometimes you might have the stock balance. So then you have to consider both and then identify the opening, the investment value, and then the ending closing investment value, divided it by 2, give us the average investment. So therefore, average investment can be calculated as the initial investment, that is I0 plus last year investment, that means IN, divided by 2, which is mentioned here. How you can take the average income? Average income means profit here. If you are considering the profit deficit, you have to consider the tax also. Therefore, earnings before interest and tax minus tax amount divided by the number of years gives us the average income. Here, earnings before interest and tax minus tax, and then divide it by the number of years and then take total of it. Now this is the ARR is something different. Why? This is the only calculation where we identify the accounting part. All other techniques identify the cash flow valuation. Here only we consider the profit calculation. Right. Okay. Try to do the question number 7. This is the last question. You have given the profit, but before calculating, before starting the calculation, and before starting the tax flow also. Read the question. The project will cost 40,000 and then it gives the earning before depreciation, interest, tax during the first year, the fifth year, 10, 12, 14, 16 and 20. Right? Tax rate is 50 and depreciation is based on the straight line method. You have been given the cash flows or the profit before deducting the depreciation and the tax. So therefore you have to consider both and then need to take the average net profit for the year. Right. Okay. Here. First year, second year, third year, fourth year, fifth year. We have the EBIT, earnings before interest and tax. EBDIT, what do you mean by EBDIT? Earnings before depreciation, interest and tax. EBDIT. For the first one, is it 12,000? Is it 12? For the second year, how much is it?
First year 10,000.
First year 10,000, second year 12,000. Third year 14, 16. Okay. We have to then, when we are calculating the profit, we have to calculate the depreciation and then the tax also. Therefore, depreciation. Depreciation will take the working number 1. Depreciation working number 1. 40,000 is the project value and then divided it by how many years? How many years exactly? That is 5 years, which gives 8,000 per year. 8,000 per year depreciation. Minus 8,000. 8. Now it gives us the earnings before interest and tax. 2,000, 4,000, 6, 8, 12,000. Now you have to consider tax impact. How you can take the tax? Earnings before interest and tax multiplied by 1 minus tax rate. It gives us the after tax profit. Tax rate is 50,000. Calculate it. EBIT after the tax. Here, how much is it? 1,000, 2,000, 3,000, 4,000 and 6,000. Right? Why that is 50? Right? 50,000 tax. 50% tax. Total of the net profit 10,000, 2,000, 3,000, 4,000, 6,000 means how much is it? 15,000. This is what? This is total profit, right? Total profit. What do we need? We need average. We need average. Now we'll identify the ARR. ARR. ARR equals average income. AVG, average income divided by average investment. Average investment. Average income, how you can identify the average income? 16,000 divided by 5, and then how you can take the average investment? We have 40,000 I0 initial investment, but we don't have the last year investment, so therefore just divide the 40,000 by 2. This gives us the ARR. Online students, what is ARR? Online students, what's the ARR? Yes. What is ARR? 0.16, that means
16%, madam.
Okay, thank you very much. 16%. Right. Okay. So these are the some of technical terms, calculations you have to consider when you are taking the investment decision. Other than the quantitative factors, so there might be some qualitative factors, urgency, importance, and then the relevance, and likewise, lot of qualitative factors involved in the capital budgeting decisions as mentioned here. Sometimes you have to depend on not only the quantitative factors but the qualitative factors. Okay, so we can have sessions without having the debate, so therefore we will go to the marking assessment. Are there any the students who are unable to participate for the quiz, please inform them. We'll have the quiz on next week, right? Online students, if you are unable to participate for the quiz, please inform your students. We are going to have a quiz next week. Again, from the same sessions, right? So any updation on the current session? Again, I'm going to conduct the quiz based on the past, based on the question, lessons that I based for the questions.
Madam,
Yes.
can you please assist me to update my attendance, madam? I have issue with my mobile data, please.
Okay, right. Tell me the next number.
EX027, madam. DL Jaya Singha.
Yes, right.
Yes,
Okay.
madam.
The,
27 number, madam.
from exception, no?
Yes, madam. EX, yes, correct, madam.
Okay. Okay, can you say again? Thank you very much for your participation. Thank you.
Thank you, madam.
Okay.